podcast day, June the 8th. We have oil prices opening in Asia a little bit higher, just popping their head above 120, holding on to those gains. That big break from the 110 to now the 120 handle, sort of it's like getting to base camp 2 before we ascend to Mount Everest. Let's kick off with Ole Hansen, head of commodity strategy at Saxo Bank. Ole, what base camp are we at? What does Mount Everest look like to you?
Well, the most obvious thing would be that we are just in a holding pattern here before we eventually move higher, because really, as long as we see demand as strong as it is, especially into the coming summer months, with increased demand from the Middle East, but also what I expect to be a very strong driving season and flying season across the world. We've been locked down for 2 years. We want to get out. We're all getting squeezed on our purses, but savings has been accumulated during this past few years. So there's many that will be on the road. So demand is likely to remain strong. So I think we're still in a situation where really we need to get to the point either the economic outlook starts to deteriorate further, or we get to prices high enough in order really to kill demand, thereby balance the market more.
Andy Levin, COO of Sahara Energy Resources. Andy, we had Janet Yellen yesterday saying that higher inflation is going to be around for a while. That sort of message started to creep in everywhere. And as Ole points out, people seem to be getting used to it, comfortable with it, still going on holidays. Can we get to $150 oil without demand destruction reversing course?
I think the world has moved on since we last had oil at that price. And I think the answer to that is simply yes. So if you look at a macro level, I was just looking at the graph here, since May 2020, the oil price has just been going up, really. There's been a bit of volatility, but the trend is upwards. And as, Omar doesn't say it, but most traders say the trend is your friend. So I think 120, 130, 140, 150 is definitely possible. I think the world actually has been living in a very low interest rate environment for a long, long time, and it needs a healthy dose of high interest rates to get a bit of reality back into businesses.
When you say high, Andy, what does that look like these days in this new reality we live in? If 150 isn't high on Brent, what's not high on interest rates?
Well, I kind of go. So my daughter is just buying her first house, and her mortgage rate is some ridiculously low number. And I go back to when I bought my first house, and at the interest rates back then were in double figures, right? So we've experienced double figures, and the world kept going. So that's why I say we've been in a very low interest rate environment for a long time, and I actually don't think that's very helpful. I think people need to earn money, and they need to generate revenue, and it needs to be a little bit difficult. So I think we're going to be in a place where high interest rates will become the norm. Question is, how quickly do we get there? And that's the balance between the issues of recession versus politics.
Yeah, there's this kind of 4-day work week, yeah, 1% interest rates, yeah, everything is like print money, yeah. A bit of dose of reality of the good old fashioned, yeah, probably would bring certain things down to earth. Omar Al-Ubaidli, welcome back to the table, Director of Research, Bahrain Center for Strategic International and Energy Studies. Omar, I think perhaps one of the very few things that might stop or could at least maybe slow down to stop oil prices getting 150 would be the UAE and Saudi Arabia actually meeting OPEC Plus's commitment to add 650,000 barrels a day. Obviously, they're way behind the curve on the 400, multiple months behind. Now we're at 650. If they were to sort of catch up with all of that barrels that they never delivered, that might do it. What's your expectation that they will actually do that?
Well, first of all, I don't think that the effect of that would be as big as one might imagine. I think it would help, as you say, But I think that the continued question marks over the future of Russian oil, and also the persistent question marks over, the lack of oil investment. You remember, we're in this situation because we had a protracted period of no oil investment, and on this occasion, as compared to previous occasions, people are always reluctant to invest in oil because of the green movements and sustainable development goals and so on. So those two macro factors are going to weigh on markets much more than a few 100,000 barrels here or there. But as you say, if what are the prospects of that happening? I think that in the long run, first of all, OPEC plus Saudi Arabia and the UAE are feel a much bigger affinity to OPEC plus than they do to the US's capricious oil demands. And don't worry about the headlines. There's a lot of politics and rhetoric going on in the headlines.
I don't think it's only capricious Washington demands. I live in Dubai, and I think for the last week, every time I turn on the radio, they're barking about high gasoline prices at the local pump just down the road here. So everybody's feeling the squeeze here on that point. So just to sort of put it out there, this isn't some unique sort of experience out in Oklahoma. This is everywhere.
I agree, but in terms of local prices rising, that's never really been a catalyst for a change in oil policy somewhere like Saudi Arabia or UAE. These things are decisions taken at the highest strategic level with with implications that take into account much longer horizons. So I think that if OPEC plus comes up with a way satisfactory to all for this to happen, then it can happen. But I expect that the US pressure alone is not going to be enough to make any significant change.
Ole, we're also seeing, if you like, all boats rising again. The equity markets are up from their March lows, and now oil, obviously, again, all commodities hit a record on the index earlier in the week. Is this the dead cat bounce across asset classes in a bear market? What's your own assessment on the equity side of things in terms of the financial markets as a whole? Many are calling this a pause before the next down.
I think the short answer to that is a yes. We are still concerned about further losses, and we also have to remember that we actually did some studies recently just looking at the kind of bounces that we had during downtrends in recent major stock market corrections. What surprised us quite a bit was the great financial crisis in 2008-9. We had I can't remember the top to bottom drop. It was more than 20%, quite a bit more than that. And during that correction phase, from the top to we hit the bottom, we actually had 41% of the trading days being up days, even though we ended up being significantly lower. So these 5 to 10% bounces, they're not unusual. We have to accept the fact that the global economy is slowing. World Bank downgraded yesterday. We got the Fed. Atlanta Fed GDP now pointing maybe towards a recession in the second quarter as well. That basically means that we will have an official recession in the US. So and with rates going up, as mentioned as well, it's really difficult to see that we need to find a new equilibrium in the stock market, and we worry that we haven't found that yet.
Well, how do we, just to follow up on that, how do we square the circle of there's 11.5 million jobs in the US unfilled, twice the number of unemployed people in the US economy, and yet we're talking about recession? I mean, these are just very strange coexisting facts. Where does one point to in terms of that looks incredibly bullish, that looks not? So how do you put those two together?
Well, I think we just have to look at something like the retail sector right now. We saw these downgrades recently. Target once again yesterday just added to the pain. They're left with a lot of inventories, which suddenly can't flood because consumers are holding back on their spending, and that will start to filter through. People's job habits has changed as well over the past couple of years. I think there's no matter where you are in the world, if you walk past a hotel or restaurant, they're all looking for staff. They seem to have vanished into thin air. But I think generally the fact that mortgage rates are starting to move higher, the fact that we are, as as Andy mentioned earlier, I remember as well the mortgages being in double digit. My dad took out a loan at 21% back in the 80s. We have a world which is so highly indebted that the question is really how high an interest rate can the world economy actually afford and cope with. And I think in the US we are not that we're not a million miles away from pain levels. So I think we just have to look at the sales and how consumers are reacting to these prices. And as I've mentioned, we will have a strong summer because there's pent up demand there. But as we head into the autumn, we could see a different picture unfold.
Well, your average American and myself included, you might put $5 in your car, but you're not going to buy a new barbecue at Target or whatever the option might be. Andy, I wanted just to get your views a little bit on the commentary that we had earlier in the week. Mike Muller was flagging, and that was, yes, these sanctions, EU energy sanctions, are perhaps a mixed bag, but when you drill down into it, there's things like you have to show paperwork in order now to why you took Russian oil, that there are layers of bureaucracy coming in, the shipping insurance issue, and that's on the kind of sanction side and probably pushing away maybe your peer group and the big energy trading companies. But yet there's a whole nother world opening up of other sort of less reputable, less known energy traders here in Dubai and elsewhere, maybe trying to fill that gap. I'm wondering, from your perspective, can they fill that gap or not, or where that will be, do you think? Sorry, Andy, you're on mute. Yep.
So I think the answer to that is they can, to an extent, right? I think that we've been through oil embargoes and sanctions for many years now, and the kind of companies that you're talking about have learned how to do things. They've learned how to manage the paperwork, they've learned how to manage positional data, but equally the regulators on the other side have learned how to put sanctions in specific ways to make it difficult. And I think that's what really drove the insurance market system, which is actually, if you can't get it insured, immediately you make it more difficult people, right? Because it's kind of, how am I going to get my product insured? And that's bigger risk to some people. But there is always going to be people who will take advantage of significant discounts in pricing and use their own vessels or not insure staff or whatever it may be. I don't think they're going to be able to fill the market totally, but then, Russia's oil and gas industry is not pushing out as much as it has been. So it like everything, the market will balance, and those type of companies are part of the market balancing. And I think we're just seeing a tightness as a consequence of it. And there is no way that the market is currently seeing, as was being said earlier by Omar, that OPEC is able to fill that gap. Therefore, you're going to have tightness. And the sanctions just make it a bit tighter, but they're not making it go away totally.
Omar, can you give us your analysis? And obviously, you've referenced it in your earlier comment about this infamous Biden visit to the region, and particularly to Saudi Arabia, and talk your own sense of how these dots are connecting. We saw before the OPEC Plus announcement last week to incrementally increase the OPEC quota. There was visits by senior American energy/State Department diplomats that seemed to preset that decision, perhaps. And then we have the Iran negotiations, or lack thereof. What do you think is delaying this meeting? What are the key components do you think that the Saudis need and the US need in order for a Biden MBS meeting to take place in the coming weeks?
Well, I think that, first of all, this Biden's overtures to Saudi Arabia regarding oil are a red herring. If you look at what voters are interested in America at the moment, they're focused on inflation. And the effect of oil prices on inflation in America, if you look at the actual breakdown of the sources, it's not that high. I mean, I'm not saying it's irrelevant, but putting, first of all, Saudi Arabia doesn't have as much of an effect on oil prices as we might like to imagine because of the two macro factors that are beyond Saudi Arabia's hands that I mentioned. Secondly, even if they did have an effect on oil prices, then the effect of gasoline prices on overall inflation isn't that high in the US because so many other things are causing inflation beyond gasoline prices. And so really, Biden's falling on the old trick of trying to blame Saudi Arabia because it's a convenient and sometimes willing scapegoat for whatever domestic economic problems they're facing. They've made a hash of the economy and of inflation. And to be honest, Saudi Arabia is much more useful to Biden if it appears to be an intransigent cause of, consumer price inflation rather than it being a willing partner, because if it actually helped, then it would expose the fact that it's not really having an effect on inflation. So I think
not putting aside the nots, the can'ts and the won'ts, what do they need to do in order for this meeting to take place? Because clearly there is very public statements that there is an attempt to make a meeting happen. And I wonder, from your fairly experienced analysis, what would need to be in place for that to happen from your perspective?
I don't think it will happen before the elections. I think he's just flirting to make it look like he's not the cause of inflation, so they can get the votes he needs after November. Maybe then there'll be a meeting once the elections are out of the way. From now until November, my expectation is that he'll continue with this to and fro, but the meeting won't happen because the political calculus within his party and within the US favors him avoiding that meeting for the time being. It wouldn't be if it happened, America wouldn't get by Biden's criteria what it's looking to get, and it's better for him to delay that, politically speaking.
Ole, the sort of wind in the sails that helped lift Brent from 110 to 120 amongst a few things, but one big one was the sort of reemergence of China from its medieval COVID lockdown. I'm wondering, from your perspective, is that now over? China is back to the races. There's certain reports that, China may be open, but the Chinese aren't spending. Your thoughts on how significant China is and will be for the energy and oil markets?
Well, probably more important for the metal market, since we had a 25% correction since the outbreaks. Oil markets has actually held up very well, and that obviously also adds to the risk that we could see prices move even higher as demand starts to recover. But I think, having been through such as you call it, quite a draconian lockdown, it will take time to return to where we were, and we also obviously keeping a close eye on the government and its attempt to stimulate the economy, because obviously the growth levels that we've seen China drop to is clearly not acceptable. So we're looking for some stimulus to support the recovery. So I think we haven't seen it all yet on that front. So again, they'll just add to the competition for global crude over the coming weeks and months.
Andy, just to pick up on that point, there seems to be emerging in Asia and maybe everywhere, but certainly in Asia, a tale of the haves and the have-nots, a tale of the two cities, if you like, that there is countries under increasing serious duress, most notably Sri Lanka, but Pakistan and others not far behind. I'm wondering, again, coming back to the earlier question and then putting it in the context of those sort of weakening Asian countries, how do the oil trading world and the energy suppliers continue to engage countries that are on the borderline of default, or will they back away? Or because when you lose the big actors, the Vitols and all these players, and you're left with these smaller actors, you're wondering how does that play into a moment like this for countries like Pakistan, Nepal, Bangladesh, and others?
So I think this is a continuing story that we saw right at the beginning of COVID, where you saw the haves and have-nots, and this is just going to exacerbate it and make it worse. If you just thinking about specifically Sri Lanka, I think the people that historically have supplied countries like that are backing away from it because they are concerned about not getting paid. Now, clearly they still need fuel, so clearly somebody will, but the price is going to go up. And there will be defaults, so they'll back away and the price will go up. So realistically, it makes it increasingly difficult for people like that. And it's very unfortunate, because the reality is for Sri Lanka, it's a political situation they've got themselves into. And unfortunately, I don't see it changing for them or for many others for a long time to come. And it's going to just make it a lot worse, where the haves got more and the have-nots have got even less.
Omar, I wanted to pick up on your thoughts on where we're at the moment vis-a-vis the Iran nuclear talks. We had reports earlier this week by the IAEA director claiming that it was nearly unstoppable for Iran to be getting towards the amount of uranium they would need for nuclear weapons. Your thoughts on that scale of development doesn't seem to be in the ether. It doesn't seem to be making the kind of noise that one would think how significant that would be, or maybe it's not. Maybe it's kind of baked in the cake, as they say. Your thoughts on that and the outlook for that?
I think that the reality is that after, even though the prospect of a nuclear armed Iran is scary for many countries in the region, in the world, the reality is that in the last 10 years or 20 years, the Middle East has shown that it's capable of, brutal violence without nuclear weapons. And also, nuclear weapons are previously a deterrent against a country invading another. The only country that really would have been at risk of invading Iran was US, and for the time being, the US isn't in risk of invading anyone. It's obviously lost its appetite for foreign military adventures. And so really, whether or not Iran gets a nuclear weapon is no longer anywhere near as relevant. It can wreak havoc and continues to wreak havoc in the region in ways that are totally independent of its possession of nuclear weapons. It's not the main threat, nor is it going to protect itself from some threat by having it, because no way is the US going to attack Iran. So I think it's just become a bit of an irrelevance, and the sticking point about the terrorist designation of the IRGC demonstrates that both sides are much more interested in scoring points with their domestic audience and international audience, rather than they are actually achieving some material strategic advantage from securing the deal. I don't think either side is particularly serious, and we'll get to a point where either a deal happens and a deal is of no major consequence, or a deal doesn't happen and it's of no major consequence, but it's basically dying a slow death, so to speak.
Let's go to the survey question to get the view of everybody in the room on the opening sort of theme we started this morning. Will oil prices hit $150 a barrel before demand destruction kicks in sufficiently to reverse prices? Will oil prices hit 150 before demand destruction kicks in sufficiently to reverse prices? Ole, we started to talk about the sort of upward motion in prices. We articulated perhaps that the move from 110 to 120 was aided by the China reopening and a few other things. But what would be the tangible sort of air or wind in the sails, as we'll stick with that analogy, to bring it up, to keep moving higher, to go to 130? Does there need to be a trigger, an event, or circumstances? I mean, when we've headlines, the World Bank yesterday saying revising downward global economic growth and so forth, where's the wind to keep moving higher?
I think it's in the fuel markets. Obviously, there's a lot of focus on crude oil, where the level of demand destruction is. I think we still have to remember that diesel and gasoline across the world is already trading at record high levels, with refinery margins as elevated as they are right now. So that's why the trying to square the oil price right now, which is relatively low, with very, very high fuel prices, then it is ultimately the fuel price that will determine when we start to scale back our spending habits. And I think I answered no to the question, because I think we will see demand destruction before 150, because it is the fuel and product market that will determine when we get that point. And I think we are getting fairly close, but not just for the next few months, because we need to get on the other side of this strong demand period and then see how consumers react in the autumn. So I'll keep an eye on the refineries' ability to keep up, and whether we are starting to see any shortages in the fuel and product market, and that I think that could be the next driver for oil here.
Andy, same idea to you, and to add an extra thought to that, as Ole mentioned, once we get beyond this current high demand period. But my sense is that we don't get beyond it, because this high demand period, at least in this cycle, is going to continue, given the inventories are significantly lower. It's storage, particularly on the gas and other needed ahead of this sort of winter coming, in terms of the tensions with Russia, that demand will remain strong through this year because of the unique nature of all of the factors. But your thoughts on that point?
No, I totally agree, Sean. I think the problem is that lockdown has meant people have been able to save some money, and the pent-up demand has money sitting behind it. So it's almost like, I don't care how much my holiday is going to cost me.
My helicopter, is that what you were going to say?
Yeah. So I think, unfortunately, through this year, even when price goes up, I think we're going to still see people going, oh man, it's cost me $2,500 rather than $2,000. But hey, I'm still going to go. So I don't see this year any demand destruction because of inflation. The only place you'll see is if China decides to lock down again. And then if they lock down, you'll get demand destruction and you'll get supply destruction. And that's the problem with it, right? So I don't think at the moment, the economics of what people want are sufficiently weak to hold back the demand.
Interesting. Let's get the survey result and give the last word to Omar this morning. Okay, a big sort of overwhelming 3-1 here that oil prices, yes, will hit 150 before demand destruction kicks in sufficiently to reverse prices. Omar, that's a lot of money for our neighborhood. That's a lot of fiscal rebalancing of the balance sheets. Your thoughts on what that means, and ultimately for the region geopolitically? Does it, you articulated earlier in earlier comment, the Iran nuclear thing, not a big deal as it was. $150, $120 oil is huge revenue for the neighborhood, even for Iran, who are obviously getting oil to the markets.
So I think one of the things to watch is that this is a litmus test for the improvement in governance in the Gulf countries. In the past, there's no doubt that these something like $150 oil would have been, big bonuses for public sector hiring binges, etc., etc., etc. Now it's a test of their discipline. Can they use these windfalls and invest them in the right kind of changes they need their economy? Can they continue to maintain discipline in public sector hiring and public sector compensation or not? If they can maintain that discipline, then I think it's a good sign for the economic visions. If they revert to type, then I think it's a very negative signal and raises real question marks over the future of these economies once the energy transition gathers pace and once oil prices return to something that is more sustainable in the long run. I personally think at the moment that it's leaning towards them being a bit more prudent, but I'd say it's 60-40. It's by no means a done deal. Let's keep our fingers crossed for the sake of our pensions.
And deploying that capital in the context of the energy opportunity into greater and greater production capacity?
I would say if they're wise, there will be, especially in the case of Saudi Arabia, Oman, and UAE, which have huge amounts of space, they should be investing as much as possible in solar, wind, and hydrogen, and all these alternatives, which there's manifestly a huge amount of demand for. They should also be spending that money on integrating their grids with the regional grids and with eventually the EU grid, so they can sell this. All this renewable and clean energy directly to the EU without having to worry about ships stuck outside Shanghai harbor and so on and so forth.
Ships stuck outside Shanghai harbor. It sounds like a quote that could have happened 100 years ago. It's happening now, and perhaps will continue to be a challenge. But Brent crude oil trading this morning at $120.94. One still has to look at it on the screen and go, oh my goodness, that is a chunky number. Not one we've seen very often in the history of time. Brief moments it's popped there under great duress moments, but nonetheless very, very rarely stayed. And there it is. But listen, thank you so much to our great three speakers, Andy Lavin, Ole Hansen, and of course Omar El Obeidly from Bahrain. And thank you. And Omar, you're sounding a little bit under the weather, so we do appreciate that you mustered the energy to join us this morning. So thank you, everybody. We'll catch up every morning, 10:30 UAE time. All the best.
Thanks, guys.